Something extraordinary just happened in the silver market that almost nobody is talking about, and I need to show you exactly what this means for your wealth in the next 12 to 18 months, because what we're witnessing right now isn't just another commodity cycle. This is a fundamental shift in market structure that happens maybe once or twice in a generation. And the last time we saw something like this, silver went from $4 to $49 in less than 3 years. Let me show you what I'm seeing. For the first time since 2015, the silver market has flipped into a structural deficit. That means the world is consuming more silver than it's producing. And we're not talking about a small deficit here. We're talking about a shortage of over 200 million ounces in 2024 alone. Now, you might be thinking, okay, supply and demand imbalance, I get it. But here's what makes this different. Here's what makes this absolutely critical for anyone paying attention. This deficit is accelerating, and it's being driven by forces that aren't going away. In fact, they're intensifying. The Silver Institute just released their latest data, and the numbers are staggering. Industrial demand for silver hit an all-time record in 2024. We're talking about 690 million ounces consumed by industry alone. That's up 9% from the previous year. And here's the kicker. Solar panel manufacturing is consuming silver at a rate that's growing 20% year over year. Think about that for a second. Every single solar panel requires about 20 grams of silver, and the world is installing solar capacity at an unprecedented pace. China alone is adding more solar capacity every single month than the entire United States installed in all of 2020. But solar is just one piece of this puzzle. Electric vehicles are devouring silver. Each EV uses roughly twice as much silver as a traditional combustion engine vehicle. We're talking about 25 to 50 grams per vehicle, depending on the model, and global EV sales are projected to hit 17 million units in 2025. That's 17 million vehicles, each one requiring significantly more silver than the cars they're replacing. 5G infrastructure is consuming massive amounts of silver. Every 5G base station uses approximately 3 times more silver than a 4G station, and telecommunications companies worldwide are racing to build out 5G networks. We're talking about hundreds of thousands of new base stations being installed every single year. Medical applications are expanding. Silver's antimicrobial properties make it irreplaceable in wound dressings, medical devices, and hospital equipment. And as healthcare systems modernize globally, this demand is only growing. But here's where this story gets really interesting. While industrial demand is hitting record highs, mine production is actually declining. Global silver mine production dropped by 1% in 2024. And the pipeline for new silver mines? It's virtually empty. See, silver isn't typically mined on its own. About 70% of silver production comes as a byproduct of mining other metals like copper, lead, and zinc. So when those base metal prices are weak, or when those mines face operational challenges, silver production suffers. And right now, we're seeing exactly that. Major silver-producing regions are facing serious headwinds. Peru, the world's second largest silver producer, is dealing with social unrest and permitting delays. Mexico, the largest producer, is grappling with water shortages and aging infrastructure, and it takes 7 to 10 years to bring a new mine online, even if you started today. So we have surging demand meeting declining supply. Economics 101 tells us what happens next. But there's another layer to this story that most people are completely missing. The paper-silver market is about to collide with physical reality. Let me explain what I mean by that. The COMEX, where silver futures are traded, has a fascinating relationship with actual physical silver. On any given day, there might be 100 to 200 paper claims on every single ounce of physical silver sitting in COMEX vaults. That's not unusual for commodity markets. It's how they function. But here's the problem. When industrial users need physical silver, they can't accept paper contracts. They need the actual metal. And right now, we're seeing something that should terrify anyone holding paper silver positions. COMEX registered silver inventories, the silver that's actually available for delivery, have dropped to levels we haven't seen since 2016. We're talking about roughly 40 million ounces of registered silver. Meanwhile, open interest in silver futures represents claims on over 900 million ounces. Do the math on that. That's a ratio of 22 to 1. 22 paper claims for every ounce of deliverable silver. Now, most of the time, this doesn't matter. Most futures contracts get rolled forward or cash settled. But what happens when industrial users start demanding physical delivery? What happens when investment demand surges and people want the actual metal, not a paper promise? We saw a preview of this in 2021 during the Reddit silver squeeze. COMEX inventories dropped by 100 million ounces in just a few months. Premiums on physical silver coins and bars exploded to 40% or more above spot price, and that was just retail investors buying coins. Imagine what happens when major industrial users start competing for limited physical supply. And here's where the timing gets critical. Central banks around the world are in the middle of the most aggressive gold-buying spree in modern history. They added over 1,000 tons of gold to their reserves in 2024. That's the second highest annual total on record. And they're doing this for one reason. They're diversifying away from the dollar. But here's what most people don't realize. Silver has always been gold's little brother. When gold moves, silver follows. But silver moves with much more volatility. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is currently sitting around 88 to 1. Historically, that ratio averages closer to 60 to 1. And during precious metals bull markets, it can compress to 30 to 1 or even lower. In 1980, it briefly touched 15 to 1. So if gold is at $2,650 an ounce right now, and that ratio compresses to just 60 to 1, we're looking at silver prices around $44 an ounce. That's an 80% gain from current levels. And if we see the kind of monetary crisis that central banks seem to be preparing for, that ratio could compress much further. But let me show you why this isn't just about ratios and technical analysis. There's a wealth transfer happening right now that most people can't see, and silver sits right at the intersection of that transfer. Think about what's happening in the global economy. We have $35 trillion in U.S. government debt. We have interest payments on that debt exceeding $1 trillion per year. We have a Federal Reserve that's trapped between fighting inflation and preventing economic collapse. And we have countries around the world actively working to reduce their dependence on the dollar. The BRICS nations, representing nearly half the world's population, are building alternative payment systems. They're settling trade in local currencies. They're accumulating gold and other hard assets. This isn't conspiracy theory. This is official policy. China's Belt and Road Initiative is explicitly designed to create trade networks that bypass the dollar. Russia and China are settling energy trades in yuan. Saudi Arabia is now accepting payment for oil in currencies other than dollars. What does this have to do with silver? Everything. Because when confidence in fiat currencies erodes, people don't just buy gold, they buy silver too. And silver has something gold doesn't have. It's affordable for average investors. You can buy meaningful amounts of silver with a few $1,000s. Try doing that with gold at $2,650 an ounce. Silver is the people's money. It always has been. And when currency crises hit, when inflation accelerates, when people lose faith in their government's ability to manage money, they turn to silver. We saw this in Weimar Germany. We saw it in Zimbabwe. We saw it in Venezuela. And we're starting to see it in countries like Turkey and Argentina right now, where citizens are desperately trying to preserve their purchasing power. But here's what makes the current situation so unique. This time, we have industrial demand that's absolutely non-negotiable. Solar panels need silver. Electric vehicles need silver. 5G networks need silver. These aren't discretionary purchases that can be delayed. These are critical components of the global energy transition and technological infrastructure. So even if investment demand stays modest, industrial demand alone is enough to keep this market in deficit for years to come. Now let me pause here for just a moment, because if you're sitting on $100,000 or more in retirement savings, there's something you should know about. I put together a comprehensive guide on how gold IRAs work, and it's available in the description below. It covers exactly how you can get physical precious metals into your retirement account without triggering tax penalties. It's worth checking out if wealth preservation is part of your strategy. All right, back to where this market is headed, because the supply-demand fundamentals are just the foundation. What's happening in the derivatives market is where this story gets truly explosive. Commercial banks are sitting on massive short positions in silver. We're talking about concentrated positions held by just a few large institutions. And these positions have been the subject of investigations and lawsuits for years. But here's the thing about short positions in a physical commodity market. They work great when supply is abundant and demand is weak. But when the market flips into deficit, when physical demand exceeds supply, those short positions become incredibly dangerous. Because unlike stocks, where you can theoretically short forever, commodity shorts eventually have to deliver physical metal or buy back their positions. And if there's not enough physical metal available, or if the price starts rising rapidly, those shorts can face catastrophic losses. We saw a preview of this in the nickel market in 2022. The London Metal Exchange had to halt trading and cancel trades when a massive short squeeze threatened to bankrupt major participants. Nickel prices went from $25,000 per ton to over $100,000 per ton in a matter of days. Now, I'm not saying silver is going to quadruple overnight, but the structural setup is remarkably similar. You have concentrated short positions, declining physical inventories, and surging demand. All you need is a catalyst, and potential catalysts are everywhere. A major mine disruption in Peru or Mexico could instantly tighten supply. A surge in solar panel installations could accelerate industrial demand beyond current projections. A currency crisis in a major economy could trigger a flight to hard assets. A regulatory change in the derivatives market could force short covering. Any one of these events could be the spark that ignites this market. But let me show you what I think is the most likely scenario. We're going to see a slow, grinding squeeze. Industrial users are going to keep consuming silver at record rates. Mine production is going to struggle to keep up. Inventories are going to continue declining. And at some point, probably in the next 12 to 18 months, the market is going to wake up to the reality that there simply isn't enough silver to meet demand. When that recognition hits, we're going to see a repricing event. Not a spike and crash, but a sustained move higher as the market adjusts to the new supply-demand reality. And here's why I'm so confident about this timeline. The deficit we're seeing now isn't a one-year anomaly. The Silver Institute projects deficits continuing through 2025 and 2026. That means we're going to be drawing down inventories for at least 2 more years. And those inventories are already at concerning levels. Think about what that means. Every month that passes, there's less silver available. Every solar panel installed, every EV manufactured, every 5G tower built consumes silver that isn't being replaced by new production. It's like watching a reservoir drain while the inflow keeps decreasing. Eventually, you hit a critical level where everyone realizes there's a problem, and that's when prices move. Now let me address something that skeptics always bring up. They say, but silver has been in deficit before and prices didn't explode. Why is this time different? Fair question. And the answer is actually pretty straightforward. Previous deficits were met by above-ground inventories. There was enough silver sitting in vaults, in ETFs, in various stockpiles to meet the shortfall. But those inventories have been drawn down significantly over the past decade. Global silver ETF holdings peaked at over 1 billion ounces in 2021. They're now down to around 750 million ounces. That's 250 million ounces that left the investment market and went into industrial consumption. And it's not coming back. COMEX inventories, as I mentioned earlier, are at multi-year lows. The Shanghai Futures Exchange is seeing similar drawdowns. Even the London Bullion Market Association is reporting tighter physical conditions. So this time, there's less of a buffer, less inventory to absorb the deficit. And that's what makes this situation so precarious. But here's where this gets really interesting from an investment perspective. Silver mining stocks are trading at valuations that make absolutely no sense given what's happening in the physical market. The average silver miner is trading at a price-to-earnings ratio of around 15. Compare that to tech stocks at 30 or more, or the broader market at 25. These companies are generating record cash flows at current silver prices. And if silver moves to $35 or $40 an ounce, their earnings are going to explode. We're talking about potential 50% to 100% increases in profitability. Yet the stocks are priced as if silver is going to stay flat or decline. That's a massive disconnect. And it represents an opportunity for investors who understand what's happening in the physical market. But let me be clear about something. I'm not suggesting you go all in on silver or silver stocks. That would be reckless. What I am suggesting is that silver deserves a place in a diversified portfolio, especially given the current setup. Because here's the thing about precious metals. They're insurance. They're a hedge against currency debasement, against inflation, against geopolitical instability. And right now, all of those risks are elevated. The U.S. is running trillion-dollar deficits with no end in sight. The Federal Reserve has expanded its balance sheet by trillions of dollars over the past 15 years. Other central banks are doing the same thing. And all of that money creation has consequences. We're already seeing those consequences in asset prices. Real estate is at all-time highs. Stocks are at all-time highs. Even bonds, which are supposed to be safe, are showing concerning volatility. But silver? Silver is still 50% below its 1980 inflation-adjusted high. It's still 40% below its 2011 peak. And it's sitting at the beginning of what could be a multi-year bull market driven by fundamentals that are stronger than anything we've seen in decades. Let me paint you a picture of what the next 18 months could look like. We're in early 2025 right now. Industrial demand continues to accelerate as solar installations and EV production ramp up. Mine production struggles to keep pace due to operational challenges and lack of new projects. COMEX inventories continue to decline as industrial users take physical delivery. By mid-2025, the market starts to recognize the severity of the deficit. Silver prices begin to move higher, breaking through resistance at $32, then $35. Mining stocks start to outperform as investors realize the earnings leverage these companies have to higher silver prices. By late 2025, early 2026, we see the gold-to-silver ratio start to compress as silver catches up to gold's gains. Investment demand picks up as momentum traders and institutional investors start paying attention. Premiums on physical silver products widen as retail demand surges. And by 2026, we're potentially looking at silver prices in the $40 to $50 range, driven by a combination of industrial demand, investment demand, and short covering in the derivatives market. Is this guaranteed? Of course not. Markets never are. But the setup is there, the fundamentals are there, and the risk-reward is heavily skewed to the upside. Because here's what most people don't understand about commodity markets. They don't move in straight lines. They sit quiet for years, lulling everyone to sleep, and then they explode in relatively short periods of time. Oil went from $20 to $147 in just 6 years from 2002 to 2008. Copper went from 60 cents to $4.60 in 5 years, from 2003 to 2008. And silver itself went from $4 to $49 in less than 3 years, from 2008 to 2011. These moves happen faster than most people expect, and they happen because the market suddenly wakes up to a reality that's been building for years. That's where we are with silver right now. The reality is building. The deficit is real. The demand is accelerating. The supply is constrained. And at some point, the market is going to wake up. The question is, are you going to be positioned before that happens? Or are you going to be chasing the move after it's already started? Because here's what I've learned after watching markets for over 2 decades. The best opportunities are the ones that seem obvious in hindsight, but are ignored in the present. And silver right now is being ignored. Mainstream financial media barely covers it. Most financial advisors don't recommend it. Institutional investors are underweight, and retail investors are focused on cryptocurrencies and tech stocks. But the smart money? The smart money is paying attention. Central banks are buying gold at record rates. Billionaire investors like Ray Dalio and Stanley Druckenmiller have been vocal about the need for hard assets, and industrial users are scrambling to secure long-term supply contracts. They see what's coming. They understand that we're at the beginning of a major shift in the precious metals market, and they're positioning accordingly. So let me leave you with this. The silver market has flipped. For the first time in a decade, we're in a structural deficit that's accelerating. Industrial demand is hitting record highs and shows no signs of slowing. Mine production is declining and can't respond quickly. Inventories are at multi-year lows, and the derivatives market is set up for a potential squeeze. This is the kind of setup that comes along once or twice in a generation, and it's happening right now, while most people are looking the other way. You don't need to bet the farm on this, but you should be paying attention. You should be doing your research, and you should be considering how silver fits into your overall wealth preservation strategy. Because when this market moves, it's going to move fast, and the people who positioned early are going to be the ones who benefit most. The market has flipped. The question is, what are you going to do about it?